Nova Scotia, Canada is a global leader in renewable energy, including green hydrogen, offshore wind, and tidal power. Learn how you can be part of it at investnovascotia.ca.
Reality radio for a really great future. We're talking real money.
Join me as I tell a little tale of a stockbroker turned insurance agent and the little tricks that he played along the way to take advantage of you, his clients. This all begins back in the mid-'80s, about the time yours truly, Don McDonald, became a stockbroker with the firm of Dean Witter Reynolds, part of the Sears Financial Network. Well, around that same time, a gentleman by the name of James Richard Tuberosa started working for a little slimy firm called First Investors Corporation. Then he went to work for Raymond James and E.F. Hutton and Shearson Lehman and lots of other brokerage firms, and he started selling stuff to people, and he was apparently very, very successful. He continued to work for major firms over the many years into the 2020s, a career that spanned about 4 decades. However, during that time, Mr. Tuberosa racked up a total of 18 investor complaints filed with FINRA and the Securities and Exchange Commission.
Can I interrupt you there real quick? 18
complaints
that were documented. I mean, there could have been a lot.
Right,
know how this works. There's a lot of other ones that don't ever get to that point. They call in and say, hey, got to fix this. And the brokerage firm says, sure, we got this.
And when you go through the list of the complaints, you find that most of them were settled. They gave the clients money, said, you're right. But apparently, Mr. Tuberosa was still worth the trouble because he stayed with Ameriprise, the firm that he started working for in, let's see, when did he start working for them? Hold on. This little thing, in 2005. So he spent almost 20 years with Ameriprise, racking up complaint after complaint after complaint after complaint. Finally, FINRA, the Financial Industry Regulatory Authority, decided to kick him out. Said, you can't be a broker anymore. Well, he sued FINRA to get reinstated, and the court ruled just recently that he couldn't get around their process, that they were regulators and they had the right to kick him out of the business. So what did he do, Tom? Did he just fade away?
No, I mean, this is a fascinating tale that I think anyone who is an investor with a broker-dealer should read and understand.
Wait a minute. No, when we get to the end of the story, the rest of the story, it's going to be financial advisors, investment advisors too, because you can game the system.
And boy, did he. And by the way, it was 18 disclosure events on BrokerCheck, including 14 customer complaints. And as I said, oftentimes in this industry, people call the branch manager and say, hey, your guy did this. And they say, oh, we'll figure it out. We don't want to make this official. We'll write the check. We'll fix it before we get to that point.
Yeah, because if it gets official, then it starts to go against your record. It looks bad for the firm.
But the reason this comes to light, and you've done so much research on this, Don, but a federal judge has now shut down his attempt to erase customer complaints from his record by suing FINRA directly, saying that the agency, has the right to regulate. But I think this is where the story really takes a turn that people should pay attention to. I was trying to set it up for you with the going from a broker-dealer to the the aforementioned RIA aspect.
Yeah, we talked about reading these Form ADVs when you go to advisorinfo.sec.gov and you look these people up because they tell a tale. And when you look up Mr. Tuberosa, you will find that he is no longer, it says previous broker. He's no longer a broker. Now he's an investment advisor. He's an investment advisor representative with a registered investment advisor, RIA.
Yep.
The investment advisory firm he's with now is a company called Skyview Pinnacle out of Apollo Beach, Florida, of course. And he's not the principal of the firm. He got a woman, and I can't find anything on her. She has no background. I mean, literally no background.
Other
she has
than
a Facebook
registering.
page. Yeah. A woman by the name of Michelle Finnegan Miller is the principal of the firm, and she has no complaints against her because, well, she's never been in the business. She wasn't in the business until 2025 when they registered.
So
in
what
2025.
What he was trying to do is get rid of his whole problematic background, if you will, move to a new registration that would eliminate all of those prior bad acts, correct?
He tried, but that's the thing, is that the investment advisor disclosure database shows disclosures from brokers, and that's what he was trying to get expunged so that he could just show that he's a new investment advisor. And in his Form ADV, he says, Michelle says that they are, of course, going to act as a fiduciary. In other words, I believe, this is my guess, that they're using the registered investment advisory firm as a disguise, as a means by which to convince potential clients that they are acting in a fiduciary capacity when they go on to sell them. What, Tom?
Let me
what
guess.
are they going to sell them?
Let me think. I'm going to go wild from left field, hope that I'm right, and call it insurance.
Yeah. Annuity products. They have, according to their Form ADV Part 2, they have 0 assets under management. Therefore, they are applying for a reduced level of regulation from the SEC. They're applying to be an exempt advisor. An exempt advisor is one who does not actually take responsibility for managing money. Well, they're doing it, it appears, in such a way that they're not even going to bother managing money. They're just going to convince people to buy insurance under the guise of this registered investment advisory firm run by Michelle, who has a clean record.
And so the court decision, does it allow them to do this, or is it shutting them down, or
no?
neither?
Here's the problem. When it comes to insurance and investment advice, the two are entirely different businesses. The SEC has no right, as a matter of fact, they're explicitly prohibited from regulating any insurance products except variable annuities. They can't regulate equity indexed annuities or fixed indexed annuities, which is what most of these guys like Mr. Tuberosa are going to be selling. That's what they sell because that's where the story is, the great big lie, and that's where the commissions are.
Big commissions. We've run those numbers before and discussed them here.
They say clearly in their ADV that both Michelle and James, or Rick, I think he goes by Rick, are insurance licensed. They tell you right there in the ADV. If you read people's ADVs, you're gonna be almost rip-off proof, because they say in their ADV that a conflict exists by them receiving insurance commissions. And so what they've done is he has tried really, really hard to convince you that he's a different person than he was when he was a broker for 40 years and was getting sued left and right, getting customer complaints all over the place.
And
he tried to get those expunged, and then he's trying to hide behind what you will perceive, and he will even tell you should perceive as a fiduciary relationship with his new investment advisory firm.
Yeah, and so the ADV Part 2A, Part 2B, does it in any way show his history in the industry? Or is it just pick it up right now?
No, it does.
Okay.
It absolutely does. When you go to his ADV Part 2, and I am on it right now, you look at his ADV Part 2, and it shows disclosures. And if you click on those disclosures, you'll get a list of them because he couldn't get rid of that broker affiliation. Luckily, the court ruled against it and kept those on his record. So anyone who looks him up will see those disclosures. And this is the moral. The moral is You must look up any advisor with whom you do business. Any advisor. And you'll find most of the good ones have zero disclosures. It's not a normal thing to have disclosures.
No, and I think in our company, not that we're the greatest of all time, but we have 19 offices, and I don't think there's one disclosure among all 19 offices, period. All the advisors. So I think I'm right when I say that. I have another question. So you could learn the history there. You could learn the disclosures. And boy, anybody that has 18 that's a whopper. You don't see very many of those people. Here's another question for you though. With the great state of Florida, is there any way when you go, because they're registered in Florida then, since they're
they're actually, they have a temporary registration with the SEC because they applied for the exempt status.
But you have to have $100 million for that.
No, because it's exempt status. Because the exempt status means you're not managing money.
I see.
You'll never get to $100 million because you don't manage. You don't have a limited power of attorney.
You're not actually managing anybody's money technically. Then.
Right.
You're
correct.
Okay. So that's not much help. But I will say another thing in addition to the ADV is anybody you work with who sells you a product, who talks about returns, who makes promises that I know they do with these products they're selling, that's not somebody you want to work with anyway, right? I mean, because they're product pushers. They are not really investment advisors per se.
Right, and in this case, this guy and his new buddy Michelle are really apparently, and again, I can't prove this, but I've been in this business for a long time, and I think my instincts are pretty good. And given the fact that I read through their entire Form ADV Part 2, and it does emphasize the fiduciary relationship that a registered investment advisor is supposed to have with their clients, here's the problem. That responsibility, that fiduciary obligation only applies to the times when they're when they're giving you advice on assets that aren't insurance products, or that aren't under their registration as a broker if this guy was still registered as a broker. So it's a very weak umbrella that protects you. I mean, this one in a light breeze is going to flip inside out. Yeah,
and so again, going back, and it's a great story because it does indicate that it truly still is caveat emptor. Anybody you're going to work with, you got to go back and read the ADV Part 2A and Part 2B. You should not work with anybody who has any, I would say, disclosures of any kind, especially 14 customer complaints. And I wouldn't work with anybody that wasn't an ethical organization because just this week, Don, in addition to other bad acts, I believe I have this right, Wells Fargo has paid another $1.25 million and was censured for resolving 493 municipal securities trades across a 7-year stretch. I mean, these are organizations that are ethically challenged. I wouldn't work with anybody
They are ethically. That is a great way to state it. They are ethically challenged. They're a little fast and loose with the rules.
Exactly. And when they have to go back and say, okay, yeah, we got it, only because they're called out on it, that's not somebody you want to work with. This gentleman, frankly, should not be in the industry. And has been allowed to continue in the industry by, again, unethical organizations that really, at the end of the day, I'm sure he's a productive broker because that's why they keep hiring. I'm sure he can sell well.
And here's the clause. I love this. I just pulled it up in their Form ADV. Here's the one that they're using as a guise, this is their disguise. And I don't know that we have this in our ADV because you wouldn't push it that hard unless you expected somebody to read it because they didn't trust you. So it's under their Code of Ethics, Conflict of Interest, and Personal Trading Clause, section. According to the SEC, they have Section A, Fiduciary Status. I don't believe I've read this anywhere else. According to the SEC, an investment advisor is considered a fiduciary. As a fiduciary, it is an investment advisor's responsibility to provide fair and full disclosure of all material facts. In addition, an investment advisor has a duty of utmost good faith to act solely in the best interest of each of its clients. Skyview Pinnacle and its representatives have a fiduciary duty to all clients. What?
I've never seen that in ours. It might be
because
there, but I've never seen it.
when you go further and you read their insurance disclosure, listen to this. Certain investment advisor representatives of the firm are also licensed as insurance agents. These representatives will earn commission-based compensation for selling insurance products, including insurance products they sell to you. Insurance commissions earned by these representatives are separate and in addition to our advisory fees. Ready? This is the sentence to listen to. It's contradictory. This practice presents a conflict of interest because persons providing investment advice on behalf of the firm who are insurance agents will have an incentive to recommend insurance products to you for the purpose of generating commissions rather than solely based on your needs. They've contradicted Section A in Section E.
Tells you everything you need to know right there to me.
You've got to read these, and that is the underlying message. I know they're long. Some of them are hundreds of, if you find one that's hundreds of pages long, you don't even need to bother reading it.
Red flag.
You know that it is not going to be good for you. This one's 20 pages long. I've seen them as short as 14 or 15 pages long. They're worth the read because this is not something you should take lightly. I know they're a pain to read, but do it anyway.
I just said
my rant is over.
No, if you don't pay attention, you could be one of those people with the complaint coming up soon. Let's go to some questions from Fort Worth, Texas. Jenna writes us, I love the show and appreciate your science-based approach to investing. I have a question about managing sinking funds for known future expenses with unknown timelines. Specifically, looking at a major home improvement like a new roof or fence replacement, likely 7 to 10 years out, and a new car 5 to 7 years. Given these mid-range time frames, I'm struggling with where to hold the money. Would you suggest a high-yield savings account for the entire amount, or would it make sense to put a portion into something like VT or AVGE? I have no debt except my mortgage. I do have a fully funded emergency fund. Since these are foreseeable expenses, I'm trying to save them up in advance. 7 to 10 years and 5 to 7 years. Any stock exposure there, or what are you going to do?
I'd be again if my needs are flexible, like she said, 5 to 7 or 7 to 10. Yes, then I could have a portion of that money in equities.
But then you'd have to be scaling that down over time. That's the problem.
You'd have to be gradually rebalancing it toward the more conservative. So
if it was my money, I think the high yield.
I would be tempted. High yield or a CD ladder or an intermediate term treasury fund or something like that. Something with a slightly higher potential longer term yield. If rates, for example, if rates should fall, a high yield savings yield will almost immediately decline.
Yeah, and so I
you'll
think
have some locked in rates with intermediate term bonds or with a CD ladder.
Something we've all forgotten is there are periods of time where stocks have lost money for about 5 years. People that doesn't happen. Well, it has. Keep that in the back of your.
It has. Mind. It's rare, but the fact that it happens means that your needs have to be incredibly flexible, so that you and your stomach very strong. You need to know that you can ride out that storm and wait a little while to buy that car.
And good for you for looking out that far for a new roof. 7 to 10 years? I mean, I probably need a new roof in 7 to 10 years too, right? I mean, that's real planning, right? I don't know.
Well, I'm planning on being dead before my next roof, so I'm good.
7 to 10 roof or you're out, one or the other. No. Also from Texas, this time Justin, Texas, Michael writes us, I so appreciate what you guys do and the wonderful advice you provide. What a valuable financial literacy service, easy to say, you offer. Contacting you on behalf of my good friend who has a very thick accent and asked me to be in touch. She's 81, her husband's 83, and has had a stroke. Sorry to hear that. They have a diversified IRA valued at $280,000 and an annuity with a surrender value of $392,000. It's not subject to surrender charge. Annuity pays out $32,000 a year as long as the husband's alive, but declines to $24,000 a year depending on the performance of the investments. So it's been annuitized, but that shouldn't go down. That's a bit of an odd statement. But
yeah, I'd have to see that annuity because that
that's the
confuses
thing.
me that
Yeah.
there's a value to getting out of it. Oh, it's
what would it be?
yeah,
It's
but how would it
variable?
be annuitized?
If it's annuitized,
First,
I don't
my
know.
first thought is that it's a variable annuity, that it's
Yeah.
an investment style annuity. But again, I'd have to look at it. So what's the question?
Well, she says she receives the residual value upon his death, but the declining balance, she worries about what might be left to support her. The annuity fees with expense ratios, he says, about 2.6%. Her advisor,
this is a variable then. Yeah.
it suggests leaving the money in the annuity, but wonders if they should cash it in and invest it. Expenses, $9,200 a month, $4,300 a month in Social Security income, so they're trying to make up. She's currently working, making $2,300 a month. She's 81. I hope you're working because you like it, because that's not that 81's old, as Don can tell you, but she's okay with spending she's okay with spending down the principal.
I'm close, but
doesn't
geez.
anticipate leaving money. Yeah, the question really is here to what to do with this
I need
annuity.
to know a lot more about this annuity.
Exactly.
I would need to know
Yeah.
a lot more about this annuity. There's something fishy here.
But just in a
And-
general sense, though, if you had $400,000 and you wanted to take out, $30,000 a year from that,
Ooh.
but they're in their 80s, so they're not like starting in their 60s.
Still, it's a reach.
It's a reach.
Still, it's a reach. It's a draw. It's a run out of assets if you live to be 100.
Yeah, that's true. So I would
that
run
would
those
concern
numbers.
me.
But I wouldn't want to
And
be in
here's
any
the thing-
portfolio that's if it's declining in terms of the payout, which I don't understand, and is charging you almost 3% a year. That's pretty spendy.
Yeah, I don't understand a couple of things. I don't understand the fact that it's a single life annuity, if that's in fact what it is. It is, I believe, totally irresponsible of any married couple to annuitize an annuity based on a single life. I know you get less money every
Unless you
month,
don't like the other partner or something.
but generally speaking, guys, you're going to die before she does, generally speaking.
Yeah.
That's why the reduction is so large, because the insurance companies know that the woman is likely to live longer. I still think it's because they do something to kill us off sooner, but I'm not sure what it is. I can't prove it. So
I can prove it if you want. I'd give you the whole
Okay.
list if you really want to know.
but I don't know what to do with this.
Well, no,
It's,
I would have to. This is a case, and it's true basically if you have any annuity, I'd have to look at the annuity. I'd have to see it because I just don't
they're
have
all
enough information.
so different.
They are.
And so convoluted.
Yeah.
And this
Yeah.
is one of the reasons why we don't like them. It's not because they're all bad. It's because they're designed. They go out of their way to make them as opaque and confusing and complex as they possibly can because it helps them sell stuff.
Michael writes us from Sterling Heights, Michigan. What's the best investment for a recent college graduate in her Roth IRA account? Thanks. You guys are awesome. Love the dad jokes. So you know you're going to get good advice when you say that.
Not from me.
Because you don't have any bad dad jokes.
You're on your own now.
I know. This is
It's
so
all your
easy.
show from here on in.
By the way, I asked my nearly high school graduate last night, what's the best type of account to have long-term for you? Is it a brokerage account? Is it an IRA or a Roth IRA? And she unhesitatingly said Roth IRA.
Look at you training
love
that
it.
girl.
Oh,
you are a
way more.
champion brainwasher.
Yeah.
What's the best investment? There isn't a best investment. There are some good investments.
Yeah, we don't know that.
Somebody young, AVGV.
Oh, switching over, adding in the
Value and small cap
Yeah.
tilt to the AVGE. We go to AVGV, which is value and small emphasis at Avantis. That would probably be my top choice right now. I'm going to use that as my final
gonna be
answer.
that's going to we're going to get bombarded now with letters, cards, emails, etc. So, okay, good luck.
That's my answer.
Okay, let's see. We have another question. Hello, Pacific Northwesterners. I've listened. This is from, I want to pronounce this right, Vikash in Seattle. Okay. I've listened with interest to the Suckers Rebellion episode. I think that's the one where we told
which one
that was
is.
where we said young people are taking a different course. I agree with your position that every generation has its hard times. It just happens to be a different type of hard. It made me wonder, how does this generation have it better than past investing generations? Way better. in many ways. Way worse in many ways, too.
Options and fees.
Yeah,
and
he even mentions
and
accessibility of index funds, no-load fund fees, fee-free trades, etc. So there's a lot of information. That's also bad. There's a lot of bad information, especially if you're getting it from YouTube, TikTok, Insta, etc. There's horrible stuff there. Can you do an episode on how this generation has advantages we never had, not to make them feel bad, but to encourage them? Not everything is stacked against them. I don't know. I don't want to.
He just kind of did it. You did it. You said it.
Yeah.
It's not.
And done properly.
And every generation says the same doggone
We had it so tough compared to the other one. Here's the thing. The reality is, and I've tried to, I think I mentioned this, that I read this book for teens about investing with my daughter, and we skipped about half of it. Because you don't need, or maybe 2/3. There's a lot of stuff you don't need. You really, if you open a Roth, you have some income, you put the money in the Roth, you invest in AVGV, I guess that's our new...
Or AVGE.
Our new favorite. That's really all you have to do. It's pretty, it's... Will it all work out in the end? We don't know.
That today, because of this, because of all of this academic research, because of all of the competition, the competition is fierce, so the fees have plummeted, but the products have improved. They offer you greater diversification. They offer you some incredible factors that nobody could afford to do 20 years ago. You couldn't afford to do small cap emerging markets value stocks in a portfolio.
Nope.
Those the price of doing business on those foreign exchanges was just astronomical. The fees were killer. But now it's so much easier. Here's the thing, though. Every generation has had it better as an investor than the previous one.
If you did it right.
Right. Yeah. Easier in terms of access to good products and good information. It's always been better
at lower cost.
Yeah.
No
in the 1850s, it was hard to be an investor.
You just had a couple of railroad stocks, maybe a railroad bond, you're all set.
Well, you didn't even have those in the 50s. In the 50s, you had canal stocks.
Yeah. Two. Yeah, minerals and the canals. Yeah, Erie Canal, right?
Yeah.
Works for me. I just want to make sure my portfolio is properly exposed to Colombia, the country, which was up 112% in 2025 and is already, here in the middle of January, are you ready for this? Up 9% year to date. 9% year to date. So I just want to make sure.
Don't run out and try to buy Colombia just because Tom mentioned it.
And
by the way, I want to congratulate you for not, earlier on the question about the sinking fund.
Yeah, you knew something was coming there, right?
I so appreciated the lack of Edmund Fitzgerald jokes.
That, and I'm holding my nose with the sinking fund, too. I hope that's okay. So.
It would be the stinking fund.
Oh, okay.
Yeah.
Broke the code. Yeah. I love the book, and I just listened to another podcast on the Edmund Fitzgerald.
Yeah, if you want to add to our pile of questions that sits in front of Tom on a daily basis, which he fondles,
my war on
strokes
trees,
because they're chunks of trees. Go to talkingrealmoney.com, and he could actually just read these off his iPad or his computer.
I could read them right off of my tree.
But no, he must read them off sheets of paper. Add to his pile of paper by going to talkingrealmoney.com and clicking on the Contact Us button. Or if you want to save the trees, record your question with your voice. No tree will be harmed in getting those questions answered on the Friday podcast.
Okay, changing course a bit there. You know who I talked to today? I know we're running out of time. Joe Saul Seahigh. And you know what he's doing?
You talked to Joe?
I did.
What?
He's looking forward to seeing you. He didn't quite finish the marathon either, by the way. I guess we can go public with this. He was doing one where they did like 1K, 5K, half marathon, back to back to back to back.
Yeah.
Oh, that's nuts.
Oh, back to back to back to back?
Yeah.
You do them all?
Yeah, all of them in like 4 days.
Oh.
That's insane. Anyway, Joe hosts a wonderful program that we really enjoy called Stacking Benjamins, and he is but one of the amazing speakers we have at RetireMeet, which is coming up on Saturday, March 7th. And guess what? It doesn't matter where you live. You can watch it now. So you can go to RetireMeet, MEET.com, register. Yes, there's a small charge for those watching it online. If you want to come see us in beautiful Bellevue, it's in Bellevue, Washington that day. Don will be there. I'll be there. Christine Benz, etc. Paul Merriman. All of the stars of retirement. Joe, that's right. We'll be there. So join us for RetireMeet. 2026, RetireMeet.com. How about that? Is that a good pitch?
All right.
Yeah.
We're good.
All right.
We got to get out of here now
we do.
because we're hitting 30 minutes on this
Running
episode.
long.
And that's a little long. Let's go. Remember, though, we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.